Hello friends, my name is Akshay Chaudhary. Today in this video I will be covering a topic of financial management, and that is capital structure theory. So before starting with the theory, let's understand what is meant by capital structure. So if a firm need fund, it can raise money either through debt or equity. So capital structure is basically deciding the proportion of debt and equity. So there are various theories that tells us about the proportion of debt and equity. It is based on a specific uh, assumption, which is cost of debt is less than cost of equity. In capital structure, the first theory is NI approach, which is net income approach. When it says when we increase the proportion of debt in the capital structure, the overall cost of capital decreases. So it increases the value of firm because it assumes increasing debt to raise the fund is cheaper than the increasing equity for the same. So if we increase the proportion of debt to raise a capital, the cost of capital decreases. It helps to increase the value of firm. The second theory in capital structure is net operating income approach. It says that if a firm is increasing its proportion of debt in capital structure, then the firm has a financial obligation of paying fixed interest. Now, if an investor wants to invest money in a firm which has uh, more amount of debt in its capital structure, then obviously the investor think once, because now the firm has become more risky. So net operating income approach is saying that fine, that if you are increasing the debt proportion in capital structure, but on the other hand the equity shareholder will demand more return. NOI approach said that whatever benefit you are getting by increasing the debt in capital structure, that will offset from the return that equity shareholders will demand. So it is irrelevant decision to increase the debt proportion. The third theory in capital structure is traditional approach. Basically, this theory is based on the first net income approach. This traditional approach says that according to traditional approach, there is a point called optimal point. Till that point, increasing the debt proportion in capital structure will give benefit, but beyond that point, it will start giving negative returns. So it says that the net income theory is right up to the certain point, which is called as optimal point, and above or beyond that point it will not comply the theory. The fourth theory in capital structure is approach. It is also known as capital structure irrelevance theory. According to this theory, in perfect market and subject to certain presumptions, capital structure of company is not relevant as far as its market value is concerned. In simple terms, the market value of company is independent of components of its capital structure. Approach explains it through the process called arbitrage process. Arbitrage process means, suppose there are two firms, one is levered and another is unlevered. Unlevered means it doesn't have debt in its capital structure. Levered means there is a debt in its capital structure. These two firms are identical. There is only one difference in these two firms. So the arbitrage process says that the investors take the advantage of this price difference in the price of security price of security is overvalued in one market and undervalued in another market. This process will continue till the price become equal in both markets. According to approach, NI approach is irrelevant and proportion of debt and equity will not define the value of firm.